Um, Thank you for joining us today. Eric B. Chu with Chu Homes, and my special guest today is Ron Ricard with IPX 1031. Thank you everyone for joining us. We're very excited about this webinar. It's a good topic at the moment, with it being in the news, with some of Biden's potential announcements, and we'll just get started with the first one. What are the reasons to do a 1031, Ron?
Well, 1031 is the part of the tax code that allows you to sell investment real estate and buy replacement investment real estate. And in doing so, you don't have to pay the tax man every time. So if you got a rental house in, let's say, Mountain View, and you're tired of it because you're not bringing in a lot of rent, and you want to sell that and go buy a fourplex, let's say, you sell the property. When escrow closes, the money comes to a third party called the intermediary. That's what we are. You then go find that fourplex that you want to go buy. We send the money to the title company on that side, and it closes. In the eyes of the IRS, you sold investment real estate and you bought investment real estate. And because you never touched the money, you get to defer paying taxes on the profit that you've made.
That sounds great. And that kind of answered the first question about why do people do it. Next question, of course, Ron, is what properties qualify for 1031 exchanges?
Well, first off, I'm going to go back to your first question.
Okay, sure.
You asked the wrong, when you asked, why do people do exchanges? I think there's much more to that question than what I just said.
Sure.
Believe me.
Let's dive deeper into that. Good point.
But with regard to what kind of properties, it could be any kind of investment real estate anywhere in the country. So you can sell a rental house and buy a shopping center. You can sell a farm and buy a fourplex. You can sell bare piece of land and buy an apartment building. It does not have to be a house for house or residential for residential. It is any kind of investment real estate for any other kind of business or investment real estate. Okay.
Yeah. So let's go back to the first topic.
Okay.
Yeah. What do you have to say about that?
Well, you asked the question about why people do exchanges.
Mm-hmm.
And the way I like to think about it is you don't do an exchange just to defer taxes.
Okay.
The easiest way to defer taxes is just don't sell it. The reason you do an exchange is because you want to buy something better. And what does better mean? Well, better means whatever you think it might mean. It could be I want to move to Arizona, so I'm going to move my rentals to Arizona. It could be I'm looking for better cash flow. It could be I want to go buy a property that later I might retire to. It might be I'm looking for less management. Maybe I'm looking to increase my cash, increase my real estate portfolio, so I'm going to leverage this to more and bigger properties. I mean, the reason I want you to think about 1031s isn't just a way to defer taxes. It's a way to reposition your money from what you own today to what you want to own tomorrow. And when you think about it that way, 1031 is a really powerful tool.
Sorry, I muted myself for a second.
You scared me there.
No worries. I have a lot of background noise, as you can hear, so I'll just ask my question and mute.
Okay.
Of course. What about my primary residence, Ron? Can we do anything about that? Like my current house that I live in?
Well, your primary residence is not considered to be investment real estate. I mean, most of us think our primary residence has been a great investment. It's made a lot of money over the years. To the IRS, it's not an investment property. So when you sell your primary residence, it's under a different section of the tax code, section 121. When you sell your primary residence, if you are single, you get to keep the first $250,000 of profit tax-free. If you're married, you get to keep $500,000 of profit tax-free. And if your gain is more than that, and the property is strictly a primary residence, then you pay taxes on whatever that excess gain is.
Right. And so are there any strategies that we can employ with the primary residence that can take advantage of both? Right. I've heard, from me personally, right, from talks that you give and other people as well, that there are some potential strategies that allow us to capitalize on both the 250, 500 married exemption, as well as 1031 for the additional gain over that 500 if you're married, or 250 if you're single.
No, that's exactly right. So there are two strategies. First off, it's not uncommon, obviously in the Bay Area, $500,000 of profit on your primary residence, if you've lived there any length of time at all, is not a huge amount of money. And especially in parts of the peninsula and most of the South Bay, having $1 million plus of gain in your primary residence is pretty common. So there are two strategies that you could have if you have a proper to try and minimize that tax liability. The first one is, does any portion of your property qualify? So in other words, do you have a property that you rent out a basement? Do you have an ADU? Do you have a home office? Is there any portion of the property that you are already declaring today as investment property? If so, then whatever percentage of your property that you are showing on the tax return as the investment portion, you can do an exchange on that percentage of the property. So let's say you, Eric, have a home office and you've been showing 20% of your home office on your tax return. Well, what that means is when you sell the property, let's say for $1 million, to pick a number at random, 20% of the sales price goes into the 1031 exchange, and against the other 80%, you still get your full $250,000, or if you're married, $500,000 exclusion against. So there is an advantage to do that if you have already been declaring a portion of your property as investment on your taxes. For most of us, though, we don't have a home office. We don't have an ADU. So what do we do? Well, real simple, move out. Turn your house into a rental property. Now, after you've been renting the house for a couple of years, is it now an investment? Yes. Is it still considered to be a primary residence? Yes, because it still meets the criteria that you've lived in the property 2 of the last 5 years. And because of that, it actually meets both criteria, so you could take advantage of both tax rules at the same time. So let's say you sold your property for $2 million and you're married, you get to pocket $500,000, and then you could do a 1031 exchange on the remaining 1.5 million. So it's a way for people who have a highly appreciated primary residence, an exit strategy. Now, this does not work for everybody. If you need the money from your house to go buy yourself a bigger house, it's not going to work. But if you have the financial flexibility or other assets where you can have another place to go move to, or you can buy something that you can move to without having to sell this property, that's a good long-term strategy.
Yeah, those are 2 really good points. And like, for people that are considering like building an ADU, or they already have an ADU, that's something that people probably don't even know, right? That they can exchange the investment portion of their existing property already, right?
Yep.
So they capture the full exemption from 250 or 500, and some of the excess they can possibly exchange. So,
well, one thing to note there, you're not just exchanging the excess profit. You're exchanging all of the sales price minus the exemption. So the basis you have in the property, what you bought the property for, that goes into the 1031.
Got it. Yeah. So then another question, right, would be, are there other type of properties that don't qualify for a 1031?
Yeah, the most common one people think about are flipping houses. A lot of people will buy a beat up old house, fix it up, and sell it. And so you're in your mind, you made money on that property, but to the IRS, that's not considered to be an investment property. Similarly, a development, you buy a bare piece of land, build a house on it and sell it, not investment real estate. To the IRS, those are properties held for resale, not held for investment. So flipping real estate, developing real estate does not qualify. The other kind of property that doesn't qualify, that is very common, is second homes. That little beach house you like to go to on weekends is not investment real estate. A vacation rental is investment real estate as long as it meets the IRS definition of vacation rental, but a second home does not qualify.
So I guess that kind of leads us to the next one about second homes, right? That they can, if it's an investment rental property, right, your second home, and it doesn't, if you exclusively use it for yourself.
Right. If it's exclusively used by yourself or your family, then it's not considered to be an investment property. Similarly, if you have a family member living in a property and you're not charging them market rate rent, again, it's not considered to be investment real estate. It's considered to the IRS to be a second home. And when you finally kick your kid out of there or your deadbeat brother-in-law out of there, then you pay taxes on that property because it's never been shown as investment for tax reporting purposes. So if you do have a second home that you would like to exchange, you need to start renting out that property either on a full-time basis or at least meet the IRS definition of what a vacation rental is. And believe it or not, a vacation rental does not need to be rented out very much, but the key is your personal use of the property as a vacation rental cannot be more than 2 weeks per year in most cases. So again, the key here about a vacation rental is you can't use it very much. And for at least the first couple of years before you sell the property, you want to meet that IRS definition.
And something that I think Ron would agree with is that you need to consult with your tax professional about these kind of questions, right? So we're not offering tax advice. Ron and I are not tax professionals. We're just speaking from our own experience, and that we're advising everybody to talk with their tax professional about all of this stuff. And we're just talking in general to give you ideas, right? And if you want a referral for any resources, feel free to reach out to both of us, and we'll direct you in the right person that can advise you on that, right? I guess moving on to the next topic, what are the different, stages of real estate investment that we could kind of look at?
Well, what do you mean by that? Sorry, just make sure I understand your question.
Yeah, so what if I want to build a real estate empire? Should I look at cash flow, appreciation? Is there different exit strategies that I should consider? That kind of stuff.
Well, that kind of goes back to why people do exchanges. I kind of look at this as a generational thing. If I'm 30 or 40 years old and I have the money to start investing in real estate, I'm looking to build my real estate empire. For the most part, I have a job. I don't necessarily need cash flow for my property. So for most people, when they're doing exchanges, they're looking to reinvest that money into something that's going to build. They want to take the equity and re-leverage that into more and bigger properties. As we get older, though, you're going to get to the point, someone closer to my age, is thinking to myself, well, maybe one day here, not too distant future, I want to retire. Now, appreciation was nice, but I'm much now more interested in cash flow. I would like to turn these properties into assets that that are generating income for me, so that when I do retire, I can start living off the income, or at least helping me offset by getting some income off the property. Ultimately, though, most of us will get to the point where we are sick of our real estate. We're tired of investment properties, and we're tired of managing it and dealing with the tenants. So for them, now now you're going to get to the point, and a lot of people will do that when they retire, of looking for what we would refer to as an exit strategy. That's where you're looking to, either cash out and just pay the taxes, or, a better solution is to buy real estate that you don't have to actively manage. And there's a lot of different kinds of properties that are less management intensive and more cash flow predictable, like triple net or net lease commercial properties, where you're buying a Walgreens or a Jiffy Lube or a McDonald's, and you're basically have a mini 15, 20, 30, 40-year lease with a major company who is leasing the property from you. That's a pretty common thing. Another thing is you can buy a fractional interest of real estate called DST. But again, the key here is that you're buying real estate, qualifies for 1031, less management intensive, more predictable cash flow. And those are the kinds of things a lot of people will go into as they retire to generate better income for themselves.
Yeah, I have a lot of clients that do that too. And so a new thing as well is investing in opportunity zones, right? And so that's probably a good topic. If anyone is interested, feel free to message me, and I'll bring on a fund that does accept 1031 exchanges, and they're building buildings in downtown San Jose, right by the new Google campus, right? And that's very hands-free, right? They manage the entire process. You just either wait for some appreciation, you get some small cash flow during the building phase, right? And
Yeah, I know a little bit about opportunity zones. The first thing to realize about opportunity zones is that they are not part of a 1031 exchange,
okay,
because at the 1031 exchange, you have to actually buy deeded interest in real estate. In an opportunity zone, you're contributing it to a fund.
okay,
Also, you're contributing equity only, and you're only contributing your profit. So
right,
it's not the same as investing in a 1031 exchange. Now, that said, a lot of people will use the opportunity zone as a fallback if they don't find a property for their 1031, because one of the things we haven't touched upon yet is that you only have 45 days from when you sell your property to know what you're going to buy in replacement. And in today's marketplace, 45 days is not a lot of time.
mhm,
So it's very common for people to start their exchange, and if at the end of the 45 days they haven't found anything, well, their exchange fails, they get their money back, and then use that money to go in the opportunity zones. But I know very well the properties you're talking about. As a matter of fact, many of the buildings that they bought to put in the opportunity zone are people we did exchanges for, because I'm very close to the people who are developing them.
cool. And then I guess, yeah, so if you're interested in those further topics, right? So some of the things Ron mentioned, then reach out to me, and I'll point you to the right direction to go to further investigate that. I guess, yeah, let's get into like kind of the details of how a 1031 actually works, right? So say my client is selling their investment properties. They have a single family home. They rented it for 10 plus years, and now they're tired of being a property manager, or they're actually now looking for some cash flow, like you mentioned, right? The rent of one single family house might not be as advantageous as a multifamily or apartment building. How do they do that? Right? Like, what do I do? Like, they call me, I'm going to point it to you. What's next?
Well, the thing to realize is an exchange itself is not complicated. You're selling investment real estate and you're buying investment real estate. You just need to make sure there are a couple steps to know about. So, Eric, you list the property for them. You find a buyer. Once you're in contract with the buyer, that's when we get involved. Yeah. We have to be involved before escrow closes, because if you close escrow and have not engaged an intermediary, you're not doing an exchange. So we have to be involved. Once escrow closes, the funds from the sale come to us, and that then starts a very specific clock. You have 45 days to identify what you're going to buy and 180 days to actually close escrow. Both of those clocks start the day escrow closes. 45 days to tell us what you're going to buy, 180 days to actually buy it. And those are absolutely critical clocks. No extensions, no exceptions, no excuses. They are calendar days. And essentially what it means in today's market especially is, by the time you get to day 45, you need to be in contract on what you want to buy, because you don't want to be identifying a bunch of properties and on day 46 they're sold to somebody else. Yeah. So realistically, by day 45, especially in today's market, you want to be in contract to buy something. You want your inspections done. You want your loan approved. I mean, you want to be locked in so that you feel comfortable that you'll be able to complete your exchange. Most of our clients are actually done with their exchange before day 45. But unless you're buying new construction, the 180-day thing usually isn't a big deal. A 45-day clock really is the critical clock.
Yeah, and I guess something that we've heard about in the news, right, is potential changes, right, to 1031 with some of the stuff coming out of the Biden administration. Maybe educate us on what you've heard so far. And of course, nothing has been great, like solidified yet or certain yet, but there's definitely been discussions, right?
Yeah, there have been discussions, and the current administration proposal is to limit 1031 exchanges. The last one I heard is, this keeps evolving. The last one I heard was $500,000 per person, or $1 million per married couple of being able to defer gain. The reality though is this: 1031 exchanges have been around for literally 100 years. They started in 1921, and a lot of times over the years, the last time being actually in 2017, when the Republicans passed the big tax cut back in 2017. 1031s were on the chopping block then, and it was only because we were able to convince them it was a very bad idea that they kept exchanges. And until we actually see a proposal in the form of a bill to be presented to Congress, I'm not going to be overly worried about what is, whether or not 1031s are going to change. Again, it's been talked about for decades in terms of changing it, eliminating it, expanding it, whatever, and it's really never changed. So I don't expect there to be a huge push to do this. We have a lot of friends in Congress who love exchanges on both sides of the aisle, on both ends of the political spectrum. And I would expect that, we will eventually see some kind of tax proposal bill by the administration. I will say you probably will see an increase in the capital gains rate. And there probably will be some other taxes to look at. Whether or not they're going to actually want to mess with 1031 exchanges, who knows? We'll have to wait to see what bill is proposed. At this point, all we know is that, part of the spaghetti that the administration is throwing up against the wall has to do with potentially eliminating exchanges, limiting exchanges.
Yeah, and to solve all those worries or any problems is we can just do the 1031 now, right? It's a great time to do it. And something to also think about and talk with your tax professionals, depreciation, right? So that's a strategy that some of my clients use, is they depreciate down the property as much as possible, and then they exchange it to the next property to depreciate down as much as possible, and then exchange it to the next property. And another thing to think about, right, for inheritance and estate planning, right, is that currently, which subject to change, like with anything, currently there's a stepped up basis, right? And so if you just can keep on deferring your capital gains taxes, when someone in your estate passes away, one of the owners, if it's a married couple, then the remaining heirs get the stepped up basis. And then you can defer, and then get a stepped up basis. And that's actually a really good point. I mean, because remember, 1031 does only defer the taxes, not eliminate the taxes. So if I sell a house, buy a fourplex, and 3 years later I sell that fourplex and just cash out, you are paying taxes from both properties. But there are two reasons you always want to look at doing the exchange. The first is that for those 3 years, you got an interest-free loan from the government, because that money that you didn't have to pay the government today, then you're just in, there's no taxes due. So as long as you get to defer it, you're basically getting an interest-free loan for the government. And then ultimately, as you suggest, Eric, it's really a matter of hopefully, you pass it on to your heirs. Once you pass it on to your heirs, they get what's called a step up in basis. All of your capital gain gets eliminated. They can sell the property the day after your funeral, just like my kids would do, and pay nothing in taxes. Exactly. And then what about Proposition 19, right? So that's a topic that actually I'm going to be covering in the next webinar in the beginning of July, but let's touch on it briefly to give people kind of a sneak peek. Overview of Proposition 19 is the potential of transferring for your primary residence, if you meet certain criteria, age, if your home is damaged in a fire unit, wildfire area, there's different rules on that you can potentially transfer your property tax basis.
Yeah, I get that question a lot. What's the intersection between Prop 19 and 1031 exchanges? And the answer is real simple. There is none, for two reasons. The first one is that, remember, Prop 19 has to do with local property taxes. 1031 exchanges has to do with capital gain taxes, which are state and federal. So there's no nexus there. And the second thing is, as you just alluded to, Eric, 1031 is for investment real estate. Prop 19 primarily has to do with primary residences. So there's really not a direct connection between why somebody, what Prop 19 has to do with, how it affects 1031 changes. It really doesn't, because they really are on different sides of the real estate scale. And I would not, and I really don't think there's there's not anything in Prop 19 that's going to drive anything in 1031 exchanges. I may be wrong on a very small overlap in certain situations I can think of, but as a rule though, there's really no connection. But I think that the expansion of Prop 19, how You can move to anywhere in California now. You can buy property that's more expensive. I mean, there's an expansion part of Prop 19, which is really good. If they took away from it on the inheritance side,
Yep.
but they really increased it on the primary residence side. But I look forward to hearing to your talk in July and to get into that in more detail.
Yeah, and we're kind of wrapping up here in about 30 minutes. This is kind of like an introduction to 1031 exchanges, and if we have enough interest, we can kind of do a further deeper dive into 1031s. And Ron has a lot of knowledge and experience on 1031s. He's my go-to 1031 exchange person, and he's the one you call when you have a question or concern about 1031 exchanges. So if anybody has any questions or wants to know advice on the best way to take advantage of 1031 exchanges, then feel free to reach out to me or reach out directly to Ron, who will make things happen. He's the best resource. Like, there's a lot of people out there that don't necessarily have the same experience, but they still do the same thing. They can complete exchanges, but it's really important. Similar to my clients that work with me as a realtor, there's differences in experience and service and knowledge, right? And Ron is great.
I appreciate that very much. Thank you, Eric. I know you have your phone number there. I'll just mention my phone number if that's okay.
Yeah, please.
Yeah, it's also a 408 number. It's 408-483-1031, 483-1031. That's my direct number, and happy to talk to you whenever you got questions about this.
Yeah, and I'll send anyone that reaches out looking for 1031 to you as well.
That's great.
So thank you so much for joining us today on our talk about 1031 exchanges, and looking forward to the next talk. And maybe we'll hop back on, especially if there's a bill that comes out that affects the 1031. Then we'll definitely have another webinar to update folks on that, and that'll be pretty timely as well.
Sounds great.
Thanks so much, Ron.
Thanks for having me.
Bye-bye.